Yes, morning everyone who's listening this Monday morning. I'm delighted to be here with my colleague Daniel Casadi. Daniel Casadi is our Chief Strategist, who's been holding the hands of many an investment manager over the last number of years through the various situations that are developing. And really what we're talking about today is really inflation and the current energy crisis that we're finding ourselves in. My name is Christopher Golding. I'm the lead investment manager in Jersey on the Evelyn international side of the business. So without further ado, over to Daniel.
Thanks, Chris. Yes, hand holding is certainly right, and certainly not fist bumping. I mean, it's been a tumultuous year so far, and I think the key thing here is what's been driving it. It's really about energy, and it's really about inflation and the Fed tightening interest rates. So we're staying defensive during this energy crisis, and I think the whole issue about energy can be epitomized by this photo when President Biden went to Saudi Arabia trying to get the OPEC and the Saudis to increase oil output. In fact, what we've seen last week was them actually reversing it and looking for a 2 million barrel a day cut in oil production. What this really tells us is really in a very strange period of time, because we've never seen a situation where we have an energy shortage and OPEC is actually cutting oil production. The last time that happened was really in the 1970s. But how the energy is manifesting itself is really in higher inflation. And today I'm going to talk about just a quick market review. Secondly, I'll look at the macro market outlook, looking at the headwinds and the tailwinds. And finally, look at the investment strategy, what sort of areas we should be investing in. And we look at 5 specific themes. So here we can see that in the market backdrop, we've basically seen the biggest spike in inflation for 40 years. We've not seen this for generations. We've also seen that we have huge energy shortages, and this is adding to inflation. And this has led to really this inflation hangover, which incidentally is the 13-year anniversary of the movie. But while there was twists and turns in the movie, eventually we got to a final place. It's going to take a while there, and during this process, it will involve lots of volatility, which we're seeing at the moment. So overall, we're still staying defensive during this energy crisis. And I'll explain what that means later on. So first, how did we get here? And I think the way we can describe this is start to look at how events drive inflation. And I think probably the biggest market event really goes back to, and we have to go back more than 50 years to the 15th of August, 1971. That's when the US reneged on their gold standard, where you could exchange dollars into gold. That was a key event because it basically allowed the pandemic spending that we've seen today. And one way to show this is looking at this iconic Campbell's condensed soup. And the reason why I've chosen this is because it's the same homogeneous product for the last 120 years or so. So it's not subject to government statisticians fiddling around with the figures, or to something called shrinkflation, where you can adjust the size of a product but keep the price the same. So in this case, the iconic 10 3/4 ounce Campbell's condensed soup has been the same all the way through. And we can see how this led to higher inflation. What it essentially meant was that we moved to a pure fiat currency system. And that essentially means that governments, instead of being restrained on how much debt they could issue, depending on how much gold they hold, that remained, basically broke the bounds with this break of the gold standard. And then governments could spend as much money as they effectively wanted. So it's only because of the Nixon shock in August of 1971 that we're able to spend as much money as we did during the pandemic. Just to illustrate how these the inflation feeds through to the cycle, we're basically gone full circle. This chart here looks at the US Consumer Price Index inflation. We can see how it led up from the late 1960s. This was after President L.B. Johnson's Great Society reforms, which was essentially spending lots more money, as well as having Cold War spending and Vietnam military spending. There's a much lower unemployment rate, so very similar to today. Then we had these 2 oil shocks, and of course, in that we had the Nixon shock. And one of the reasons why we had such high levels of inflation was the fact that wages were index linked to the consumer price index. So as inflation rose, we also saw wages rise as well. And then what we find with these events, they generally happen every 10 years, bizarrely. So after the Nixon shock in August 71, we then had 10 years later, in August 1981, this is when President Reagan sacked 11,000 air traffic controllers. That weakened the unions, and it weakened the pricing power that workers had as well. We also had at the same time Paul Volcker raising rates aggressively at the Fed up to 19%. So we had this strong axis between Reagan and Volcker, which drove down inflation over the next 10 years or so, when Tim Berners-Lee, he's a great British inventor, he invented the web page 10 years later, again in August 91. And I mean, we all know the story about the internet matching buyers with sellers and the price discovery, but interestingly, the first web page doesn't actually exist anymore. And then we had another 10 years later, which led to another leg down in inflation when China joined the World Trade Organization in December 2001. And of course, that led to the increase of supply of labor coming from China to keep wages down. Another 10 years later, we had the Euro debt crisis with the Greek bailout, and it led to a whole raft of austerity in the Western world. We had very weak growth in those 2010s, and that led to another leg down in inflation. Then fast forward to today, and we have another event, bizarrely another 10 years later, that's the pandemic. Just to give you an idea of how much spending has gone on, both from the fiscal side and on the monetary side, we can see that if you want to look at how many dollars have been created since the end of 2019, we can see that 42% of all dollars that have been created since 1913, when the Federal Reserve started, have been created since the pandemic started. So there's no wonder that we start to see higher inflation. It's not due necessarily to the Russian invasion of Ukraine. This started because of fiscal and monetary spending by the authorities. Of course, we can't neglect what's going on with energy. And with energy, we also have another driver of inflation, but we have to go back a little bit further for that one. And that's really related to the climate agenda. If we look at what the big oil companies have been doing, and this chart looks at the capital expenditure, how much they're actually investing to keep fossil fuels going. Believe it or not, the amount of capital expenditure by all the listed oil companies is virtually the same as when the Paris Climate Agreement went into force in November 2016. Yes, the energy price has gone up very high, and that's led to record free cash flow. Free cash flow is now exceeding $1 trillion if you look at that green line. And if you want to understand why, I would suggest listening to this interview with Mike Wirth, the Chevron chairman and CEO. He done this a couple of months ago. It's on YouTube. Basically, he's saying it doesn't matter what the price of oil is. It doesn't influence their capital decision, for the simple reason that if you have governments rowing back against fossil fuels, they're not going to be investing more in fossil fuel production. And that's where we are today. We have a supply squeeze, which has been made worse by, as I said at the start, with OPEC actually reducing oil production. And let's not forget that some of the European oil embargo on Russia doesn't actually happen until December with a seaborne oil trade. That's going to be reduced further by another 2 million barrels from Russia. So this oil crisis, as well as the pandemic spending, is leading into this higher inflation. And so we have the situation where, number one, we're having growth rates being revised down globally. So this year, instead of being about 3.5% at the start of the year, it's now steadily been revised down globally for this year at 2.9%. If you want to look at the long-term average, it's normally about 3%. So we're looking at slightly below growth in 2022. And for 2023, those growth rates have been revised down as well. If you look going forward, with the high cost of living, high energy prices, certainly the geopolitical uncertainty and the Fed raising interest rates, growth expectations are being revised down. Worse for markets is the fact that interest rates, they're being revised up. So if you look at what the Fed futures, which is what money markets traders are expecting, they expect the Federal Reserve to raise rates to about 4.6%. It's slightly higher for the Bank of England, maybe 5 to 5.5%. And then finally, while we do have a cost of living crisis for individual, it's important to note that we still have a cost of living boom, dare I say it, for companies. Because there's pickup in inflation, companies are able to charge more, so they have better corporate pricing power. And what that essentially means is profit margins have never been higher. They're up to a record 10% for all of the listed companies that we see. So that is one important offset. But what has been driving markets down is really about rising interest rates, and I'll explain on that in a second. If we want to look at the performance review, well, in dollar terms, the all country world index, which is the very top of that bar, is down 24%. UK has been doing better. It's down 17.6%, but a lot of that is due to the currency decline. But generally, all equities have been performing poorly. The only area that's doing better is really about commodities. So we have crude oil prices doing very well, and that's led up the overall commodity price index. Bonds have been having the worst performance on record. If you look at UK index-linked gilts, they're down almost 50%. A big chunk of that is due to the currency, but also the fact that the linkers were very, very expensive, and they're linked to high interest rates. So as interest rates go up, the linkers are going down. It may sound a bit strange when you've got high inflation, but that's what you're buying. You're buying unexpected inflation, which is now starting to come down because the Bank of England is raising rates. The credit market's also been suffering because it's linked to rising interest rates. And the only currency in town has really been about the king dollar. It's been appreciating against everything. If we want to look at the second part of our presentation, it's really looking at the macro market outlook. We think that equities can recover, but there is a caveat, a huge one, and that needs to be that the Fed hawkishness needs to be showing signs of peaking. At the moment, we're not seeing that yet. We had a very strong US payroll figure last Friday. It needs to slow down further, and we need to see more evidence that inflation is starting to come down. We do think that will happen, but it's really a first half of 2023 story. So for the meantime, we're starting to see that these headwinds are more than offsetting the tailwinds. So in terms of the headwinds, we have this monetary tightening. It's not just by the Federal Reserve, it's by the Bank of England. You've seen it there in Australia. It's basically everywhere. The ECB, maybe the only exception is probably Japan. In terms of recession fears, I mean, it's almost inevitable that the UK is going to go into recession if it's not there already. The same for the Eurozone because of the spike that we're seeing in energy prices. US, that's the big one. It's looking increasingly likely that it will slip into recession sometime next year. In terms of the energy shortages, we still haven't had winter here, and we still have to see what happens with the situation in the Russian invasion of Ukraine. But at the moment, there does seem to be enough gas reserves to keep Europe warm, but that could run out by January. Huge question marks about that. In terms of the tailwinds, we do see some sign that inflation is peaking. So there is a positive out there, believe it or not. And we do see resilient company earnings. And finally, as a contrarian indicator, we've seen that investors are already positioned for the worst. So how much further can they fall? That is equities. So I'm just going to highlight some of our key themes. One is to stay invested. Second is looking at the rates outlook. Third, looking at the sterling outlook. Then finally, energy, and looking at gold, how gold can be used as a diversification tool in your portfolio. So why stay invested? Well, number one, if you look at this chart on the left-hand side, it looks at global equities, the PE ratio. So this is a sort of valuation tool. So the higher it is, the more expensive the market is, the lower it is, the cheaper it is. And I've inverted this, sorry, it's on the left-hand side, and on the right-hand side, which is inverted, it's the US 10-year real yield. And basically, as the central bank, the Federal Reserve, has been raising interest rates, it's been driving down the valuations, particularly of the very rate-sensitive sectors like the mega caps, the Apples, Amazon, Microsoft. This has been dragging down the overall broad market. So what we do see is that the valuation of the global equities at 13.3 times is actually cheaper than it was during the pandemic. And you'd have to go back to the start of 2019 to see how cheap it is. So a lot of the negative news has already been reflected in much, much cheaper valuations. The chart on the right-hand side shows you how the overall global stock market, which is the red line, has that's been performing. It's more or less, well, it's the chart on the left-hand side, essentially, looking at how the performance is. But you can also see that the 1-year forward earnings per share, which is the measure of the company earnings, has actually been quite resilient. It hasn't fallen. Now, you could argue that this is still yet to be felt into stock price, or the analysts have yet to feed this into their earnings forecast. But for the moment, with high profit margins, there is room for those earnings to still be resilient. So if we're looking at the overall market, there's still an indication that you probably should be thinking about the time in the market rather than time in the market. This chart here looks at if you had £10,000 and you invest it in the S&P 500, how it would be performing if you remained invested, and if you looked at the less 10 best days and excluded the less 30 best days. So if you were out of the market and exclude those very sharp movements in recovery, the performance can be significantly hindered. So looking at it on a longer term perspective, although markets have been quite negative or very negative this year, if you're out of the market, you will fail to capture being in the market for some of these best day recoveries, which will come at some point. But we do need to see evidence that the Fed is going to row back on its hawkishness. Within the equity space, one of the areas that we do like is the good old UK. I've not always been a positive on the UK. When I first came to the company, my mantra in 2017 was stay away from the UK because it had all the uncertainty about Brexit, the rise of Corbynism. But a lot of that's been reflected in the valuations you can see on the right-hand side. The UK looks very, very cheap if you look at a blend of valuations relative to the world, excluding UK. And all we're starting to see now, once we had our Brexit deal in December 2020, we're starting to see a recovery in those valuations. But moreover, what's driving the UK is its exposure to the large metals and mining companies and also the energy companies. So the UK is essentially a commodity play. So while our economy looks poor, it's very international in its perspective, and it's basically capturing that earnings recovery that we're seeing in some of the commodity space. The second theme is looking at the rates outlook. At the moment, we've not yet seen the peak in interest rates. Fed futures is looking at about 4.5%. You'd have to get your microscope out if you see on the very right-hand side for that red line to see rates starting to peak. UK start to come down a little bit, but still very, very high at the moment. We need to see some Fed speak or Bank of England speak, suggesting that they're going to row back in their hawkishness. But for the moment, the bar is very, very high for them to do that because inflation is at multi-generational highs. The next one is looking at the rates outlook, how we view rates with the markets. This looks at the various 11 sectors that you can break the global stock market into. So IT, communication services, consumer discretionary. We find that these areas of the market, they're very, very sensitive to interest rates, and also they're very, very volatile. And that's why we're moving out of these areas of the market this year. And we much prefer those that are less rate sensitive. So these would be defined as the sort of defensive. So that's healthcare, staples, and utilities. That's in the top right, you can see there. We like energy, adds a little bit of juice. Yes, it's got a bit more volatility, but upside volatility. But it's the least sensitive to interest rates. It's much more sensitive, as you'd expect, to energy prices. So that's how we're structuring the portfolio within the equity space, the much more defensive area of the markets, but also the sort of energy space as well, and moving away from the interest rate sensitive areas of the market. In terms of the sterling outlook, one thing that characterizes this is that while interest rates in the UK have been rising higher than the US, I showed you that in the previous chart, it hasn't really helped sterling. Sterling's been depreciating against dollar, and at one point in Asian trade, it's at 103.5. That's the weakest it's ever been. And the simple reason is that rates are not really helping sterling. And to explain that, it's really because sterling is a cyclical currency. So as growth expectations have been revised down, this is reflected in the MSCI World. So it's a reflection of developed market stock market index. This has been driving down sterling against the dollar. And essentially that means unless we start to see those growth expectations recover, there is still some downside risk to sterling. It will happen when the Fed starts to become less hawkish next year, as I said. But for the moment, there's still downside pressure on the UK. Of course, there are also idiosyncratic risks with our government, but that's another subject. The fourth theme looks at energy. We like oil and gas. It's one of our key themes. And one of the reasons here is it's not just because of the rise in energy prices and it's less interest rate sensitive, but there are structural reasons. And that goes back to the climate agenda. Because fossil fuel companies have been investing less in capital expenditure, they're basically paying out more in terms of dividends and share buybacks. And what we do see is that the return on equity, the amount of earnings to amount of equity in the issuance, is at record highs. So these energy companies are returning more and more money back to shareholders, and of course shareholders like that. And that's why energy has been very resilient during this market turmoil. And then finally, why do we like gold? This chart here looks at the gold price, which is currently about $1,700, and the green line looks at what the gold price should be if you base it on 10-year real yields. As you have rising real yields, there's an opportunity cost of holding gold against, as it's a non-yielding asset, against putting it into US 10-year real yields. But what you can see, there's this big gap you can see in the right-hand side that should explain a much lower gold price. The gold price should be closer to $1,000. So the reason is why? Why is that not happening? And I think that goes back to the sanctions that the West has done against Russia. It went back to February. One of the sanctions included actually confiscate the Russian foreign exchange reserves. So you can just imagine a lot of the autocracy countries such as Russia, China, the Saudis are probably investing more and more of their trade surpluses, not in government bonds in the West, but more into gold, so they can keep it within their own boundaries and there'll be less risk to secondary sanctions. Just to finish off, the key conclusions here is still stay invested in stocks, avoid trying to time the market. We would favor cheap UK in this environment. We see there's still increasing signs of market volatility, and this has been led by Federal Reserve, inflation, the geopolitics. We can talk about that if you wish, and steer towards the defensive areas of the market to wear this one out. Third is to look at sterling. We think that it can appreciate once the Federal Reserve becomes less hawkish, but we generally need to see growth expectations start to revise up. That looks unlikely at the moment. Oil and gas stocks, we think these are more of a structural reason to own these ones, simply because there's a shortage of energy, and we also seen that OPEC is not really helping out the West. And gold should be part of your diversified portfolio. If we looked at one lesson that we've learned this year, and that is that bonds have not offered the portfolio diversification they've had in the past, because you've got this higher inflation. Both bonds and equities have fallen down in unison this year, and we think that gold offers better diversification benefits. But also, bullion is also supported by these emerging market central bank demands that's coming through from Russia, China, etc. So I think I'll leave it there, just over 23 minutes, and hopefully take any questions.
Thanks very much, Daniel, and very sobering for a Monday morning now to talk about those and the inflationary fears that we're seeing at the moment, along with the cost of living crisis, but also indeed coupled with the opportunities, given that investor sentiment is so low at the moment. But just in case we or before any questions come through from the audience, a question on the strength of the dollar. It doesn't seem that long ago when we were talking about dollar weakness and all the various currencies competing to make themselves weaker against the dollar, but now that seems to have turned around. And given you highlighted earlier that 42% of all dollars were created since the pandemic, well, surely that should make the dollar weaker, shouldn't it?
Yeah, I mean, I haven't got a chart here, but if you look at something what we call the basic balance in the US, this looks at the trade deficit, but also about what foreigners are investing in the US in terms of bonds and equities. It's a massive trade deficit for the US. Normally, that should lead to a much weaker dollar. But the only reason the dollar is remaining high is because of risk aversion. And what we are seeing is a lot of money is being pouring into dollar cash, and that's keeping the dollar up. And this is lasting for a long period of time. Investors are looking for safety. So they're coming out of equities, they're coming out of bonds, and they just want to hold dollar cash. Dollar cash is the one asset in when you have financial turmoil that actually performs better. So what we are seeing is, because the Federal Reserve is raising interest rates and you're starting to get some return on holding dollar cash, that's giving it support. If you want to see the dollar start to weaken round, you need to see the Fed sounding more dovish. And as I said, with that basic balance in a huge negative, dollar could fall very, very sharply, but we're not at that stage yet.
Thanks, Daniel. And we have got a question here. Very refreshing to see real reasons for a change, fiat money, etc. I'm not one for investing in money for money's sake, but could we invest into so we say emerging market currencies? Do you think they're a good opportunity at this moment in time?
Well, as I said, I mean, where we have this risk aversion environment, you're basically catching a falling knife. There will be a point where the dollar starts to weaken, but the only way that we could see that would be when we start to see indications that the Federal Reserve is reining back on some of its hawkishness. What we are seeing is that Jay Powell, the Fed chair, he doesn't want to do what Arthur Burns did in the 1970s. And that's when they started to loosen up on tightening monetary policy. And you had the second leg of higher inflation that's in the second part of the 1970s. So it's quite institutional in its framework, the Federal Reserve. It made a mistake last year. It should have been raising interest rates. It said that inflation was transitory. It clearly was not. And it doesn't want to make that same mistake twice. That's why it sounded very, very hawkish. The only thing that might change it, other than looking at the Labour Day weakening, or if inflation was to slow down, would be if we saw the stress that we saw in the gilt market in the UK with the pension funds, if that was to be transferred over to the US, where you start to see credit stress and dislocation in its capital markets, then Fed would start to sound more hawkish, more dovish. But again, we're not at that stage yet. So in terms of answering these questions, investing this money, not yet.
Yeah, certainly not the time to be brave in these markets. And certainly from my perspective of the coalface dealing with investment portfolios, is that we're starting to see opportunities in the corporate bond market, where historically, well, over the recent past, you've seen yields of 1 or 2%. Obviously, the risk reward isn't really in that favor, but now that's blown out to sort of 7 or 8% for high quality corporate. Do you think they're an opportunity in diversified portfolios?
Well, the thing about corporates is they're still linked to rising interest rates. It's still very, very interest rate sensitive. So the key theme that we have from our presentation is to stay away from rate sensitivity. If you're going to be invested in the corporates where you do get a better yield, keep the duration very, very short. So you limit the amount of sensitivity to interest rates. In your portfolio, you should try and reduce interest rate sensitivity. So I would recommend longer duration corporate bonds.
Short dated.
Short dated, yes.
Okay. Yeah, and Pam just got another question there. I think that's one to perhaps cover off at a later point, because we're trying to keep this at 20,000 feet at the moment.
So Federal Reserve is privately owned, so we can't rely on them too much. We are looking at bi-regional governance in a way that can make them pay more fairly. Yeah, I mean, if you look at the Federal Reserve will do what it wants to do. It's very, very political at the moment. I think the Federal Reserve is under huge pressure ahead of the US midterm elections to try and address inflation. Certainly, we saw Jay Powell being summoned to the White House very unusually in May, and that message was made very, very clear to them. So I think the Federal Reserve has got its agenda. It's going to be raising interest rates. It may change a little bit after the November midterm elections, but you probably need to see evidence that inflation is slowing before they do that.
And a question for me, Daniel, with your crystal ball, how far do you think the Bank of England is going to push the UK economy in terms of interest rates?
Well, if you look at the futures market, they think 5.6%. I think that's extraordinarily high at the moment. We can see the domestic economy is facing very high energy bills. We've got mortgage rates going up very, very sharply indeed. I think 5% to 5.5% is the absolute max that the Bank of England can raise interest rates. We're also seeing what sort of stresses it's done to pensions as well. So I know the Bank of England is talking the talk in terms of being aggressive, but will they walk the walk? They've already started quantitative easing. They said they're going to reverse it today or stop it today, but once they've started that, they're going to go back again. The whole point about quantitative easing when it was introduced in 2008 is that the central banks, which were referees in the football terms, are now actually playing on the pitch and they can't get out. That's the real risk.
They don't know what side they're on.
Yeah. In Aussie rules football or something, maybe. I don't know.